Hey guys, it's Richard. You're watching The Plain Bagel. I had a different video slotted to go live today on a different subject, but I think given what's happened in the stock market recently, it's important to cover this topic and to rush it to the channel because a lot of people are probably concerned with what's going on. As you're probably aware, last week's stock markets crashed. Over the span of just 5 business days, the S&P 500 fell 11.7%. And it wasn't just US stocks impacted. The Canadian market was down 6.8%, and markets around the world were down over the past few weeks. We specifically saw cyclical companies hit fairly hard by the drop, industrials, energy, companies that kind of experience more of an ebb and flow with the general business cycle. And if you've been following the news, you know that the reason for this is the coronavirus or COVID-19. It's something that has spread quickly throughout the world and has a lot of people scared that we're going to finally experience that recession we've been talking about for so long. But I wanted to make this video to kind of touch base with anyone who's experiencing those anxieties and who might be tempted to sell everything and exit the market given the drop that they've experienced. Because during times like these, we are really susceptible to making poor behavioral decisions, making decisions based on our emotions rather than logic or information. So I want to take a moment to step back and look at what we do know, look at the risks, but also to take perspective on the situation so that hopefully if you do decide to make a decision, you're doing so well informed and you understand the risks that you're taking one way or the other. So let's start by going over what we know so far about the situation here. As of February 28th, we've seen the coronavirus reported in 50 countries, with over 83,000 cases confirmed worldwide. While most of those cases are in mainland China, we've also seen big outbreaks in South Korea, Iran, as well as Italy. And as a result of these outbreaks, we've seen measures taken by the government, but now also companies to prepare and to kind of warn investors about what's going to happen. Recently, Apple and Microsoft announced that certain revenues of their segments might not meet guidance expectations because there's going to be less business activity resulting from these actions. And we've even seen major festivals and religious events canceled by countries to protect people from the coronavirus that's spreading very quickly. And we've known about the coronavirus for a couple of months now, but there's sort of 3 reasons why stock markets were hit so hard recently. The first is that there are heightened concerns that a recession is coming. As you may know, China is a big player in the global economy. They represent roughly a quarter of world manufacturing. So efforts by the government to contain the virus have impacted supply chains with companies shutting down and the sort. Not to mention that a lot of countries and companies sell products to Chinese people, to the Chinese population, because they are a big growing consumer segment of the world. But recently, fears have been exacerbated because for the first time, the virus hit really close to the heart of the global stock market, which is the States. The US recently reported its first unknown origin case of COVID-19, meaning they weren't sure how this person obtained the infection or the disease. And the problem is that the States represents roughly 43% of the global stock market. So any outbreak in the States will have huge implications for stocks around the world. Now, strangely enough, disease outbreaks haven't been a big stock market mover in the past. If you look at the H1N1 and the SARS epidemics, which were roughly from 2009 to 2010 and 2002 to 2003, the stock market really didn't show any big drops like we've seen with the current COVID-19 case. But the reason for that largely is that in the other 2 situations, the stock market had already been largely depressed by other financial crises, the dot-com bubble and the 2008 financial crisis. So the stock market had already collapsed quite a bit and was sort of at a low, which brings us to kind of the second reason why stocks fell so sharply recently, which is valuations are very high. When times are going well, people tend to pay higher and higher prices for the same underlying earnings of a company. We see the multiple expand over time. And it's sort of like the same with housing. If you have a good economy, house prices tend to increase more and more over time, even though the house isn't necessarily changing at the same pace or whatever. But when things go poorly, we see housing prices fall. The house hasn't changed. It's not like the house is now at risk of falling apart, but people are willing to pay less for it because they have other things to worry about. The economy is poor, they might lose their job, and they're worried about the affordability. And it's sort of the same with stocks. Because the past decade has been pretty good for the stock market, valuations are currently pretty high. Last I checked, the CAPE ratio, which is a cyclically adjusted PE ratio, was at 28.3 times versus its long-term average of 15.8 times. That means for the same amount of profits, people are paying more than they used to in the past for the same company. And the problem is that the larger that valuation is, the further it has to fall when things go poorly. And finally, the third reason why COVID-19 hit stock markets so hard is that interest rates are currently very low and debt levels are very high. When things are going poorly, the central bank will lower interest rates to encourage borrowing, make it cheaper for people to take on debt, and that will encourage more activity, more hiring and projects and things like that. So when they're already low and then we experience a crisis, it means there's less room, fewer levers to pull to boost business activity. The other problem is that this has caused total debt to increase. Recently, the US corporate debt levels have been approaching $10 trillion, which represents roughly 47% of the economy. And the reason why high debt levels is bad for the economy is that it increases the risk of companies going under. And it makes sense when you think about it. If you have a company that has an interest rate that they have to pay every month or they go bankrupt, and then for a few months or a few quarters, they don't make any money because business activity is slowed, they could very well go under. So those are the reasons why we've seen such a violent reaction from stocks. But while it's certainly a dire situation that warrants caution and action, it's worth putting it into perspective. On the medical side, I can't obviously speak to that. I'm not a doctor and you should not take my advice on medical stuff. But there's another channel, Dr. Mike. I recommend you check him out. He has a few videos on COVID-19. But what I can say is that in China, we have seen the growth rate fall of the spread of the disease, which could show that the government action that has been used to control the virus might be effective. Obviously, we don't know if that's going to continue or the risks there, but that is somewhat encouraging. And the second point that I really want people to register to put this all into perspective is that even though stocks have fallen very quickly, and that's very concerning, on an aggregate level, they haven't actually lost that much progress. What I mean by that is if you look at the S&P 500, it's currently trading at a level where it was in October of 2019, meaning that over a 5-month period, its return is flat. Whereas for the TSX, it's actually a 4-month period that's been flat. So it's been at the same level that it was in November of last year. And while it's still a concerning situation, hopefully that gives you some reassurance that if you've been investing for many, many years, this most recent recoil has not actually set you back that much. But of course, the concern is that from this point forward, things get worse, which raises the question that I know a lot of people want to ask, which is a recession going to happen and are stocks going to fall further? But if you've been watching my videos for very long, you know that my answer to that question is maybe, but I don't know. And no one knows for that matter. Whether we have a downturn or a recession will come down to how countries, companies, and consumers react to COVID-19. If we see countries shutting down manufacturing sites, stores, if consumers stay home and don't go out shopping as much because they're worried about COVID-19, which by all means, please don't go out and spend money if you're concerned. But if that happens, yes, we could see an economic impact with a larger effect on business activity. But there are just too many variables to take into account to realistically forecast what's going to happen. And the truth is that the most immediate risk of a recession comes from fear around a recession. Fear of a recession is kind of a self-fulfilling prophecy. It leads companies to hire fewer people, maybe cancel expansion projects, and other things that inherently reduce business activity and can cause a recession. And it's funny because it kind of applies to stocks as well. Fear of losing money causes us to make poor decisions that end up working against us and can lead to sell-off in the market that obviously loses other people money. So now I know some of you are watching and thinking, Richard, could you say something useful instead of just reiterating that we don't know what's going to happen, which is true. But in terms of what we should do, it really comes down to your unique circumstances. If you're a passive investor, then you know that your approach already dictates that you don't do anything. Which is very convenient during times like these. But if you're an active investor, then it depends, but you probably should stick to your strategy. The time to really change your approach has kind of passed. We've already seen a 10% drop, which is a sunk cost. Sure, you should look at your positions and see, what's at higher risk, what has more debt that might go bankrupt if they don't get the cash flows that they need. But you shouldn't be selling just because things have dropped. Past returns are a terrible predictor of future returns. Not to mention that stock prices are already pricing in some of the risk of COVID-19. It's probably not at a bottom by any means, but it certainly shows that there is already risk priced into those stocks that you need to take into account. And keep in mind that changing how you invest and trying to time the market and predict what's going to happen with COVID-19 is a type of speculating. We just recently put a video on what speculation was, and I didn't think it would be so timely, but the truth is, if the CDC and the International Monetary Fund don't know what's going to happen with COVID-19 and how it's going to affect economies around the world, then neither does Frank down the road with his own investment portfolio. And quite frankly, neither does Richard on YouTube. But what I do know is that you shouldn't sell your stocks because they've fallen 10, 20, 30% or more this past week. Study after study has shown how difficult it is to try and time the market. There's a popular graph shared by passive investors that shows that if you miss the top 10 best days of the S&P 500, you miss out on 3.7 percentage points of return. That's a big cost for missing just 10 trading days. We don't know when those days are going to occur, but trying to guess that is very difficult. I understand that COVID-19 is a very scary and serious situation, and that a lot of people are probably panicking seeing the numbers of their portfolio drop very quickly, let alone the anxieties that come with a possible pandemic. But the truth is that all the wisdom in the field tells us that we tend to make poor decisions during times like these. We tend to show emotional biases that influence our rationality when it comes to making investment decisions. So stick to your strategy that you hopefully made during a rational time. All my passive investors out there, if you aren't doing anything, you're doing it right. But if you're an active investor, sure, understand your positions, look into the risks that they face, when it comes to China and a further recession with leverage and things like that. But make your investment decisions based on those factors and not based on the 10% drop that we've already seen. And of course, there might be some situation where it does make sense for you to sell right now. Maybe you have a short-term obligation that you need to meet, or maybe you took on more risk than you realized. It's why I don't give advice or recommendations on this channel. I don't know what your financial situation is, so I can't speak on your behalf as to what you should do. So if you have these questions or you're losing sleep about this, then speak to a professional who can help you, make a rational decision here. There are fee-only advisors as well as portfolio managers that might go through your position and tell you, the risk exposure you have and things like that, so you better understand your positions. But at the end of the day, if you invest in high-quality companies that you're confident will be here in 5 years' time when this all blows over, which, this too shall pass, maybe not in 5 years, but eventually, then you should come out on top. So of course with COVID-19, be cautious, be vigilant, both in terms of stocks and of course your health. But, be rational. Take the information that you know and make decisions based on that, not based on emotions or past performance. And to end on a very corny and cheesy note, I'd like to finish with a quote from Franklin D. Roosevelt. The only thing we have to fear is fear itself, which could not be more true in the world of stocks. Thanks for watching. I hope you found value in this video. If you did, let me know down below. And of course, all that good stuff, like, subscribe, hit the bell icon if you want notifications about future videos. Thanks for joining me today, and as always, be safe out there.